If you've been keeping an eye on the markets at all, you've probably heard the name Motilal Oswal pop up a lot. Their funds are posting some absolutely wild numbers, and you can bet investors are taking notice. But how are they actually doing it? Today, we're going to pull back the curtain and deconstruct their winning strategy to figure out what their secret sauce really is.
Just take a look at these numbers. Seriously. Motilal Oswal's mid-cap fund delivered over 64% returns in the past year. That's not just good, that's absolutely crushing the category average of around 38.5%. And this isn't just a one-off thing. We're seeing this kind of pattern across their actively managed funds. This level of outperformance is pretty rare, and it's causing a huge wave of investor money to just flood in.
And that brings us right to the big question. In a market this crowded, how is one fund house so consistently hitting it out of the park? Is it just dumb luck? A really unique philosophy? Or is it a risky bet that's just, paying off big time? Well, we've been digging through the data and listening to what their leadership is saying to find some answers. Okay, so to really start piecing this performance puzzle together, we need to understand the sheer scale of what's happening. The first clue isn't just about the return percentage, but about the reaction from investors. And we can see that by looking at how much money they're managing. And wow, this number right here really tells the story. The assets in their mid-cap fund alone have shot up by 200%. That means it's tripled in less than a year. Growth like that is a massive, flashing sign that something very, very different is going on under the hood here. All right, so how are they generating these kinds of returns? To get it, we really have to look at their core philosophy, the fundamental belief system that's guiding every single investment decision they make. The CEO of Motilal Oswal's AMC, Pratik Arora, puts it plainly. He says they are a very, very growth-focused house. Their goal is actually pretty simple, but it's incredibly ambitious: to build some of the highest earnings growth portfolios in the entire country. They have this core belief that over the long term, stock prices will always follow earnings growth. And they've boiled this whole philosophy down to a simple but really powerful framework they call QGLP. It stands for quality of the business and its management, growth in its earnings, the longevity of that quality and growth, and of course, buying it at a reasonable price. Every single company they even think about has to pass through these 4 filters. This isn't just some poster on the wall, it is the absolute DNA of their entire investment process. Now, having a philosophy is one thing. We all know that. But putting it into practice, that's where things get really interesting. How does that QGLP framework actually turn into a portfolio of stocks? Well, this is where Motilal Oswal's strategy starts to look very different from the competition. Okay, so the first thing that just jumps out at you, it's how concentrated they are. While a typical mutual fund might own 80 or more stocks to spread out the risk, Motilal Oswal runs these incredibly focused portfolios. We're talking just 20 to 35 stocks. This is a very deliberate, high-conviction strategy. Yeah, it's high risk, but as we've already seen, it can be extremely high reward. And this just shows the sheer level of conviction we're talking about. I mean, look at this. In their FlexiCap fund, a staggering 83% of the entire portfolio is packed into just its top 10 stocks. They aren't just dipping their toes in the water, they're making massive, focused bets on the companies they believe in most. So where are they finding these companies to bet so big on? Well, they're hunting for what investors call alpha, that potential to beat the market. And they're looking in new spaces that most people, and even the main index, tend to overlook. Think about things like electronic manufacturing, hospitals, and all this new age tech. Their CEO compares it to finding software companies back in the 90s, identifying these brand new sectors that have a super long runway for growth. This whole high conviction approach led us to another pretty fascinating discovery when we started analyzing their funds. When you look across their best performing funds, you start to see this significant and maybe even surprising pattern of shared stocks. So get this, the data shows that their most popular funds are actually way more similar than you'd think. Their FlexiCap and midcap funds, they share 10 stocks. And as you can see here, those 10 stocks make up a massive 80% of the FlexiCap portfolio and 70% of the midcap. This huge overlap means the performance of both of these funds is basically tied to the same small group of companies. When those companies take off, both funds take off together. But okay, here's a little bit of a twist. Despite having this long-term buy and hold philosophy, the QGLP thing, the data shows a really high turnover ratio, often over 100%. What that means is the funds are actually churning their portfolios. They're actively buying and selling stocks pretty frequently. So this suggests they aren't just buying and holding on forever. They're actively managing their bets to jump on opportunities as they come up. So this brings us to what's probably the most important part of this whole explainer. What does all of this mean for you, the investor? I mean, understanding the strategy is great, but how should you actually use this knowledge? I think this quote from the CEO really says it all. Their high-growth, high-conviction strategy, it's built for long-term investors who can stomach the ride. And that word he uses, choppiness, that's the key right there. The same concentration that creates this massive outperformance can also lead to some serious volatility. This is definitely not a strategy for the faint of heart. So, what are the big takeaways here? First, you got to understand the risk. This is a high-conviction, volatile strategy. Second, check for those overlaps. Make sure you don't accidentally buy the same portfolio twice. Third, and this is crucial, remember that performance is cyclical. What's winning today isn't guaranteed to win tomorrow. And finally, you have to embrace what their CEO calls good beta. Now, beta is just a fancy word for volatility. Bad beta is risk from stuff like high debt. Good beta is a volatility you get from investing in innovative, high-growth companies. Their whole strategy is built on embracing this good kind of choppiness for long-term returns. So there you have it. We've deconstructed the secret sauce. It's a powerful mix of a clear growth philosophy, super concentrated bets in new sectors, and some pretty active management. It's a high-risk, high-reward playbook that has, for now, paid off big time. So the final question, and it's one only you can answer, is this. Now that you know the strategy, the risks, and the potential rewards, is this the right style of investing